I'm going to turn this over to Mike Maloney
Okay.
while he gets set up.
I'm going to talk a little bit about the current housing bubble. Mortgage debt. This is the cumulative current account deficit, but look at where mortgage debt is. This is what we've done using our houses as ATM machines to buy SUVs and all of that stuff that we buy from China and Japan that creates this current account deficit. And this is people refinancing their houses. The household sector debt is a percent of GDP. This is the home builders index as compared to the NASDAQ. They look pretty darn similar there, and it has started to roll over. This is out of the local newspaper in Los Angeles. Home prices jumped 17% in the at Southland. Do we have a housing bubble? No, we've got a hyper bubble. Inflation-adjusted home index price back to 1890. This is the cost of building the home. This is the population and the 10-year bond yield. Home prices are just in lunaticsville. The home building industry, this is the insider buy-sell ratios. Now, to understand what this is, you need to know what the average is, and there's always more sells than buys because the owners of all these companies and the insiders are issued stock when they start up the companies, and eventually that stock does get sold. But it's usually around three sells for each buy. We've got 314, 331, 9,744. So all the home builders are getting out of their own industry. They know that there's a bubble here and that this is the top.
There's a guy in the building the house next door and he said, that's true.
Yeah.
That's so true.
Yeah. Banking industry. Remember that 3 is the average. 11, 11, 5.4, 9.1. They know what's coming. Debt to GDP. This is a really interesting chart. You know, we had a previous peak here. If you notice, in 1929, when the stock market crashed, we were right here. This is not people borrowing money. This is the contraction of the GDP during the Depression. People that had already borrowed money lost their homes and their businesses to the banks during this contraction. So as in a ratio chart, two things can drive this up. You can either borrow more money and it goes up, or you can shrink the GDP and it goes up. If you pay back some of that money, it goes down, or if you increase the GDP, it goes down. Well, right now we're way up here. If there's a crisis and one of these bubbles pops, if the real estate bubble pops, then you're going to see this chart just go to the moon, and the banks are going to end up owning most of this country. Federal budget trajectory. This is a projection, and we're right in here. And our revenues and our spending. I'm not as much of a deflationist. I think we're going to have a short deflation. I think that what's going to happen is that we're going to have Ben Burn the Currency Bernanke as our next Fed head, and that we're going to get well, I'll open that PowerPoint later. We're going to have the housing bubble pop. There will be a contraction in the M3 money supply because of all the tsunami of bankruptcies that's coming. And at the same time, people are going to be dumping all of their dollar-denominated assets on the international markets. Anybody that's in any dollar-denominated asset, if they're a foreigner and they see the US dollar index break its support, they're going to be dumping these. And if foreign central banks start dumping, the dollar plunges internationally. But that causes skyrocketing import prices, and we don't make that much stuff anymore. So you're going to see in deflation, I call it. Jim Poplava used to call it that a while back. But everything in the United States, houses and your wages and the things that you don't need are going to go down in price, while the things you do need, anything like oil, is going to skyrocket. As the dollar plunges, they have to offset that by raising the price to have the same purchasing power overseas. So you're going to see oil skyrocket, and then they may unpeg at that point and either start using the euro or perhaps gold. And that is the point where China will completely unpeg from the dollar because they will have nothing to lose. They import about 30% of the world's commodities, and they use more than 50% of the world's cement. And as the dollar plunges, the price of all those things is skyrocketing as long as they stay pegged to the dollar. They're going to see the same inflation in those prices as we will. And at that point, they will probably unpeg from the dollar. And then we've got all of this money flooding back to us. They're all selling their dollars on the markets. So all those dollars are coming home from overseas. J.P. Morgan, one of the original holders of the Federal Reserve, he said this before the Federal Reserve, gold and silver, our money, everything else is credit. Inflation-adjusted gold. You can see that we haven't hit these 18-year highs in prices if you inflation-adjust everything. Gold is still dirt cheap. This is the gold crude, light sweet crude ratio. And it's down in the range of 6 or 7. And it needs to get back up here at 15 or so. So we're 15 to 28, probably 18. So gold needs to rise probably 3 times to get this ratio out of whack, which is out of whack now, back into equilibrium. We've seen this chart before, but I bring it back just to remind you that this is, again, an exponential curve going right off the top of the chart. This is inflation-adjusted Dow going back to 1800. It's actually 2 indices pasted together because the Dow didn't exist all the way back to 1800. But the 1929 crash, and then you see an inflation-adjusted crash. The Dow actually bumped its head on 1,000 from 1966 to 82. But when you take away inflation, that crash was every bit as bad. You can see it overshoots to the downside here and to the upside here as the 1929 crash. And we're headed right back there. And you will see Dow and the gold meet one day. The Dow gold-silver ratio, the Dow-silver ratio. This started out at around 50 here in 1980, but it even goes lower than that. This is 81. It goes a lot lower than that in 80, but we're currently still at 1,500. So silver has a long way to go to get back to its equilibrium. The silver deficit. Now we're finally getting to the silver story. One thing that sort of bothers me is the increase in production. Part of it is because of the commodity prices in copper and nickel and zinc and lead, all the consumption that's going on in China, bringing a lot more silver to the market through the people that produce silver as a byproduct. But last year I sat here and listened to Hecla and Coeur d'Alene and Pan American talk about the increases in production that they were going to bring to market this year. And I'm working the numbers in my head, and it was something like 30 million ounces and stuff. And I'm thinking, wow, if you guys are successful, you could mine silver at a loss indefinitely. They didn't have any plan for keeping these 2 lines from crossing, and they could by just withholding some production. And then they've got that silver at a higher price. They've got it in stock, ready to sell. They could keep their doré bars, and that's what you've been trying to get them to do. You were the first one to suggest it, and thank you, Jason. I believe in that. I know that some of the miners don't, but I'm fully behind you on that one. This is a chart from right off of the Silver Institute's website. And we've got all the different types of purchases, but the one that I'm really interested in here is investment demand. And they're only showing any investment demand in 2001 and 2004. And there's this big old price spike here. But imagine a casino game, one hand of cards. If the house loses, you win 10 times your bet. If the house wins, you keep your bet anyway. And as long as you keep playing, you win. Of course, there's no such casino game, but if there were, how much would you bet? Silver is that bet. There's no downside risk to silver right now. This is the financial report of the United States. You can go to the U.S. Treasury's website and you can download this thing. These are some of the figures, but they are lying to us. This is a cash. They show us this cash accounting. You see this on the news whenever You hear what the budget deficit is, and everybody rants and raves about it for about 2 weeks, and then you don't hear about it again. Then 3 months later, they put this complete 200-page report on their website, and in there you can find a generally accepted accounting practices accounting. And I made these charts based on those numbers. Generally accepted accounting practices is what the U.S. government holds every public corporation to. That's the standard that they all have to come to. And it includes your accounts payable and your accounts receivable. The U.S. government doesn't want to live up to the same standards. This is GAAP, and if you add in the off-budget Social Security and Medicare, you add that in to the GAAP accounting, this is the cash accounting, the GAAP accounting, and then with Social Security and Medicare. These do not include things like the wars, the war on terror, the war in Afghanistan, the war in Iraq. This is $11.1 trillion. That is 96% of GDP. America is broke. Bush and Greenspan have taken us past the point of no return. It's not possible to fix this anymore. It was possible before the 2000 elections. We could have done something to fix the world economy. These are the entitlements. These are the things that are killing us. Medicare, Social Security, or Medicaid, Medicare and Social Security. But this is the interest on the public debt. And that one is ultimately the thing that's going to, you can't borrow money forever without the interest costing more than what your payment is eventually. And you have to borrow so much more money just to make that payment. And the interest the next day is so much higher that you have to borrow more money to make that payment. And you get into the runaway inflation, the hyperinflation that they had in the Weimar Republic in 1923. Debt versus income. This is just it's not sustainable. You can't do this forever. This is a total American debt. Federal, state, local, business, household, and domestic financial sectors. And we're at $40 trillion, and this chart, it starts at the beginning of 2004. Government is growing, and private industry, the private sector is shrinking. And all of these things are part of the government. Now, last year, there was a bunch of rhetoric about Iran's nuclear program, and that was really because they're going to be establishing trading for oil in euros. And they don't want to see that happen because it takes the dollar's stature away. That could be the straw that breaks the camel's back and throws our economy in a tailspin. And they're trying to, they want to maintain the power that they've got. And this is the big excuse. And we have Iran surrounded. We've got Afghanistan on one side, and we've got Iraq on the other side. President Bush just signed a $286 billion transit bill, more public works projects. We've got 3 of the most expensive wars in history. The war in Iraq, $5.6 billion per month, $186 million a day, $7.75 million an hour. Iraq and Afghanistan could be more than the total Vietnam War. Mark Faber, in the long term, any country which lives beyond its means will end up paying the price. This is the Consumer Price Index, so this is showing inflation. We've got 1944, so World War II, the Vietnam War. All the money that we created during that time came back to haunt us with people driving up the price of gold. And when Nixon took us off the gold standard in 1971, which is right there, inflation just soared. Alan Greenspan, 1966, in the absence of a gold standard, there's no way to protect savings from confiscation through inflation. There is no safe store of value. If there were, the government would have to make its holding illegal, as was in the case of gold. The welfare state requires that there be no way for owners of wealth to protect themselves. Deficit spending is simply a scheme for the confiscation of wealth. Robert Rubin, former Treasury Secretary from 1995 to 1999. We can continue to close our eyes and hope for the best. There's no way to predict whether that will work for another few months or another few years, but the odds are extremely low that our financial imbalances will solve themselves. And we place ourselves at great peril by not facing these realities. And Bush and Greenspan are definitely not facing these realities. The former Assistant Secretary of the Treasury, the U.S. has become the world's largest debtor, and the ratio of external debt to U.S. exports is approaching crisis ratios of banana republics. Let me issue and control a nation's money, and I care not who writes the laws. If the American people ever allow banks to control the issuance of their currency, first by inflation and then by deflation, the corporations that will grow up around them will deprive the people of all property until their children wake up homeless on the continent their fathers occupied. I sincerely believe the banking institutions having the issuing power of money are more dangerous to liberty than standing armies. Thomas Jefferson.